All right, good afternoon, everybody. It's 2 o'clock, so we'll go ahead and get started. So, thank all of you for taking time out of your day to come here and do this, and basically get this information, the annual update that I do. So my name is Carter Smitherman. I'm the Chief Financial Officer at Aventure, and I also serve as the Chief Financial Officer for Royal Oaks as well. And so each year I put together this presentation. It's kind of the results, if you will, the financial results for the last fiscal year. So our fiscal year runs from March 1 through 2/28. So a lot of the numbers that you're going to see in here are either at February 28, 2025, or through the year ended February 28, 2025. So before we get going, I'm just going to warn you, just like I warned the previous group, a lot of financial information up here. We'll get through it. I do have the tendency to talk with my hands a lot, so if that gets distracting, I apologize. Also, I have a tendency to just meander up here on stage. I just walk from one side to the other. If I happen to be blocking the way, you can just tell me to shoo out of the way and I'll go to the other side of the stage or something of that nature. So I do get that occasionally some angles, the things get hard to read. So let's talk about what we're going to touch on today. So first thing is we will talk about the foundation. I'll get Chuck, the development director here for the foundation, to come in and talk about the foundation and what it's been doing over the last year. After that, we will go into the results of that prior fiscal year that I talked about, and those results are going to focus on Royal Oaks. We will touch a little bit on the foundation too, as far as their financial results, but it's mostly going to be about Royal Oaks. We're going to talk about inflationary impacts. In other words, what's just some common data that I can share with you, and even if necessary, you can even go and look up on your own as to what's going on, at least nationwide. And I'll try to also break it down a little bit on a macro level as to what are some local effects that happen to be affecting Royal Oaks. We'll touch on occupancy. I don't have a full boat of slides on there, but you're going to notice a theme throughout the presentation where we talk about occupancy. And so I'll touch on that a little bit. And then lastly, we'll save time for questions. And then when we do get to the question, just raise your hand. And like I said, I can't see everybody all at once, so if I don't worry, I will get to you. But if you have a question when it comes time for it, we do have some lovely ladies at the back. They have microphones. They can come up, and if you could speak your question into the microphone so everybody would be able to hear it. Again, just a logistical issue. Okay, so for right now, I'm going to go ahead and turn the first part of the presentation over to Chuck so he can talk about our wonderful and charitable foundation.
All right. Thank you, Carter. As Carter said, my name is Chuck Tholen. I'm the Director of Development for the People of Faith Foundation. There is some confusion by people because I get this all the time. What is the difference between People of Faith Foundation and People of Faith, Inc.? People of Faith, Inc. is doing business as Royal Oaks. People of Faith Foundation is the charitable organization under that. So there is a difference. We do raise money for People of Faith, Inc., doing business as Royal Oaks. The foundation board consists of 10 members, 4 of which are residents. So you have them up there. You have Janice Daniel, Fred Yates, Bruce Burnside, and Diana Gratinger. So those are the 4 resident board members, and then the other 6 down here are outside board members. If you have any questions, please feel free. Janice, Fred, Bruce, Diana, they'll all help you out and answer any questions as well as myself. What is our mission statement? Well, it's 2 parts. One is to provide the benevolent funds. So that is the safety net that you all have when you moved in. And it basically means that if for some reason you simply outlive your resources through no fault of your own, the foundation kicks in and covers that. So you're never asked to leave Royal Oaks. That's part of that foundation. The second is to provide projects and programs that benefit both staff and residents. Now, there's a lot of programs that we do, and I'll show you a couple of highlights here. We recently completed a project for the CNC machine in the wood shop that has helped crank up production on the toy makers. These are the guys that are out there. They're making toys for needy kids and needy families, and they are cranking those things out beyond belief with that little machine. We also replaced the chapel piano earlier this year. It was in dire need of it. It was starting to die, so we bought a new piano for the chapel. The foundation covered the remodel for the Elegante Point Assisted Living Building. So Elegante Point Apartments, that's the new remodel that is there. Hopefully you all have seen it. It covered basically paint from the first, second, third floor, new carpeting, new furniture, new artwork. It really got a complete makeover on that building. Also, we've added additional furniture in the bocce ball area. That just came out. And then the Friendship House resident garden, this was a really nice one. Current resident, paid for most of this project. They really had a passion for this. They wanted to provide a way that the memory care residents could, experience gardening and remembrance. So if you notice, there's an L shape in that garden. That is to be able to roll a wheelchair up so that they can actually dig in the dirt as well. So it really is nice. They love it. I will tell you right now, Mandy over there, the activities coordinator, has told me that if there is a tomato that sprouts, they are watching it like a mother hen. They are just enthralled by that. So it has been a lot of fun for them, and they really do enjoy it. But like I said, that was some foundation, but it was also made possible by a donation from a resident. Some of the many campus clubs and groups we support, Tech Connect, Music Memory, Art Club, a lot of clubs, mostly any club out there that needs our help, we're willing to support. So that's a good thing. And finally, I can't leave this out, the foundation pays for the yarn for Yolanda's blankets. So if you have been a recipient, you know how nice these blankets are. Yolanda Landry, she hand makes these things. She does it for any resident 85 years or older. She started out several years ago making them for the Friendship House when she was volunteering her time over there. Well, she made everybody a blanket. And then she went to the care center and she made everybody a blanket in the care center. And then she started doing it for 95-year-olds and then 90-year-olds, and now we're down to 85-year-olds. So if you're a recipient of it, you know how well those are. But it's the only person I've ever met that actually wears out knitting needles. I don't know how she does it, but she has gone through a lot of knitting needles. Also, this is not really a club or a group. It's actually one of the services online. We've purchased over 100 books for the library. The library committee picks out the books. They try to keep it up to date with new bestsellers. So we've actually purchased over 100 books within this last year for them. As I said, there's also benefits to staff. And a big benefit of that is the scholarship fund. And here are some recent scholarship winners, or recipients, not winners, but recent scholarship recipients. One of the ones you may recognize right off the bat is this guy right here, Alex. He's assistant dining room manager over at Inspirata Point. Alex, this is his second time through the scholarship. He completed his bachelor's in finance. He is now going for his master's in finance. So the foundation is helping him through the scholarship, and he's very, very appreciative of all the dollars that have been given to the scholarship fund over the year. Some of these you probably are looking at going, well, he's not even here anymore. We know that. And that's the reason we do that is that a lot of, especially the EMTs, they will go through their firefighting courses through the scholarship fund, and then they are now firefighters for cities out here in the West Valley. Surprise, Sun City, they've moved all over the place. But we've sent out a good person into the world. They'll remember Royal Oaks. Their kids may work here one day. Who knows? I mean, it's a great thing for them because they really got that experience and they do appreciate it. This is an interesting one. We have spent over $10 million in the last 4 years from the foundation. So I get this question all the time going, well, you asked for money, you got all this money. Well, we've spent over $10 million in the last 4 years. So we have to keep asking for money. That's what's going to keep projects and programs going for us. So yes, we have spent a lot, but we do appreciate every dime that we get from anybody. Another part of the foundation is the Employee Appreciation Fund. Now, this is going to kick off October 1st. This is organized by a committee of 7 community residents. The reason that the foundation is involved is that your donations made to People of Faith Foundation allow you to get a tax charitable contribution. So that's why it goes through the foundation. All the money that comes in during the year is given out that year to the employees at the annual Employee Appreciation Breakfast, which is the first Friday of December. Also, the foundation and Royal Oaks team up and they cover the payroll taxes on this. So the employee gets exactly what was donated. They don't get dinged, because the federal government, state government, everybody wants their cut. This is considered income, so they're going to take their cut. So that's why Royal Oaks and the foundation team up and cover those taxes. How do you give? Well, that's why I wore a green shirt. I love money. You can give by cash or check. You can do a gift of security, stocks, bonds, anything you want. You can do a bequest in your will or trust. Leave that to us. Over here, we've got pledges. If you'd like to set up a pledge and say, I want to donate so much every year, can you help me set up a pledge? We can do that. If you want to name us a beneficiary on your retirement or your life insurance, we will take that also. We are so appreciative of any money that comes in. Every dollar that comes in, I write a thank you note, and I am appreciative and touched by it. Also, this is a very interesting one. A lot of people have started doing this qualified charitable distribution, or QCD. Now, what this is, it's a tax-free transfer of funds from your IRA directly to the charity. So you just call up your IRA, you transfer what it is. It actually satisfies your required minimum distribution, your RMD. It doesn't count toward taxable income, so that helps out quite a bit. But as always, please consult your financial planner or tax preparer. Make sure it's the right move for you. Let's talk about 2 different ways of donations. The first is a restricted donation. We have unrestricted donations. A restricted donation is you as the donor can say, I like People of Faith Foundation. I want to donate to the scholarship fund. I am passionate about education. That money is spent only toward the scholarship fund. That is a restricted donation. It is a restriction that you, the donor, put on that, and that is the only thing we can spend it on. We can't move it over to someplace else. It is specifically for that. If you said, I want to spend it on benevolent funds, or I want to put it toward the chapel, that is a restricted donation. Unrestricted basically says, here's my check. I'll let the board of directors of the foundation use it wherever they need and wherever it can provide the most bang for the buck. So those are the 2. One other thing, and this has started getting to be really popular. This started about a year ago. I started getting donations for this. A memorial donation. If someone here passes away, or you have a friend or family member that passes away, and you want to make a donation to the foundation in their name, you can do that. I send a nice thank you note or a note to the family letting them know that you made that donation. They are very, very appreciative of that. It's kind of in lieu of flowers. That's the way to do that. But also, you can specify how you want that spent. So if someone were to pass away and say, boy, they were an educator and they loved this, and they would have loved the scholarship fund. You can restrict that donation, even in memory of, to the scholarship fund. So again, you have control of your donations. All right, that was pretty quick. Any questions at all on this? Yes, sir. Hold on. Let's get a microphone to you.
Carl Feisty, tentative new possible resident. Right? And my question is, you said donations can be made, but if you can give to people $19,000 a year, why does it have to go through your foundation to be non-taxable?
I'm not sure I understand the question.
Okay,
19,000 a year.
Okay, that's what the U.S. government says I can give somebody a gift to, a gift. Okay, so these donations are gifts. Are they not gifts to these employees when you donate at the end of the year, these scholarships or whatever you're giving to employees?
No, we can give out as much as we want for the scholarships. There's no limit on that. And there's really, as far as I know, Carter, there's no limit on what you can give.
So with the with the Employee Appreciation Fund, you're right in that you can give as an individual to another individual. But first of all, there is a policy against our employees accepting any direct gifts from residents. Employees cannot accept any gifts from residents directly. The second thing is for the most part, when the Employee Appreciation Fund, the residents or donors, because sometimes non-residents donate to it as well, the donors will donate to that particular restriction, and then we'll take those monies and distribute them to the employees. Now, you have to categorize that because the foundation is providing that money to Royal Oaks to provide to the employees. So the Internal Revenue Code is going to classify that as compensation. It can be miscellaneous compensation or bonus compensation, but it is compensation. And as such, it's going to be subject to taxes. And so that's why we pick up the tax part of it. But when you say, can I gift money to people? Yes, you can gift money to people, but you can't gift directly to a Royal Oaks employee.
Okay, that's the difference then. Okay, thank you.
You're welcome.
All right, anybody else? Oh, we're one way in the back. Hold on just a second. She's bringing a microphone.
I don't think I
There you
did
go.
that, but the amount that's given to the employees, can that be considered a tip?
No.
So that in the future, they wouldn't be taxed on it anyway?
So the question is, can it be considered a tip? And the answer is no, because you're donating the money to the foundation, okay, for employee appreciation. A donation, by definition, is non-reciprocal, which means there's no exchange of goods or services. A tip would have to be considered a compensation for services, in which case you lose the tax deduction now. So it's a donation. You're not expecting any services or anything back. And then basically it's a program whereby we take the cumulative amount of those funds and we distribute them to the employees. As far as the no tax on tip, from my understanding, and I'd have to do more research into it, it's not something that automatically happens. Like the employee still has to file their taxes to get that money back. In other words, even if we had tipped employees, we would still be required to withhold taxes, and the employee files their tax return to get it back. So.
And on that amount that goes to the employees, the appreciation, if you consider like a basic, 18% to your help as far as the staff is concerned in the restaurants, what do you recommend as far as an additional amount to cover all the rest of the employees?
Well, basically, it's a contribution. You may give as much or as little as you like. I don't, because like I said, I can't start giving you instructions on how to base it like a tip because I don't want it to be interpreted that way. And what I mean by that is for the safety of keeping it as a charitable contribution. When we get into the particular program, there will be some ideas from other residents of saying, this is how I've typically gifted, this is how I've typically thought about the amount or something of that nature, but I can't tell you to use a particular formula or percentage because at this point, I'm asking for a contribution. It can be as much or as little as you would like. That's the whole point of a contribution.
Okay, then based on the fact that $700 or $350 a month goes towards food and that service, about how much of what we pay monthly goes toward the other maintenance people?
So the other question is like, can you break out the monthly service fee approximately by like how much of the monthly service fee goes to food and maintenance and stuff? And the answer is no, I can't do that. I don't have that information. The services are all bundled. And the reason for that is because they're not used uniformly either. So some people use health services more than others. Some people use maintenance more than others. And some people even utilize food services more than others. So It's a bundled contract, so I don't start breaking that out. I don't even have the data to do that at the moment.
And that program will start October 1st. You'll start seeing flyers on it. The names and email and phone numbers of the 7 resident committee members are on there. Please reach out to one of them. One of them sitting over here, Mary Ann. She would be more than happy to talk to you about that more in depth. And there's a lot of questions. We're going to have a pizza party for new residents because they really don't know a lot about the Employee Appreciation Fund. But I appreciate the comment. So with that, I'm going to turn it over to Carter and let him get going.
All right. Thank you. All great questions so far. So as we get to that section, if you think of something else, let me know. But what we're going to do is we're going to go ahead and move into the financial results for last year. So each year, obviously our fiscal year ends at the end of February, and we do undergo an audit each year, and we have an audit report. And that audit report is usually available by the end of May, beginning of June. That audit report includes Royal Oaks and other entities such as the People of Faith Foundation. So if you get the audit report, you'll notice in the audit report that the financials are consolidated because they're required to be. But in the back of the financials, we break out each entity on their own so you can even see individual entity results. So we're going to start here with the balance sheet. So in the nonprofit world, it's called the Statement of Net Assets. But for those of you that are in business or happen to own your own businesses or whatnot, it's basically a balance sheet. So this is going to be a snapshot in time, and this is going to be as of 2/28. So we're going to start with the assets, and some of the bigger assets are going to be unrestricted cash investments for Royal Oaks of $61 million, okay? So unrestricted means it's not restricted by any external party. There's no regulations or contracts or anything. This can be used for operations, okay? Property and equipment net of about $197 million, okay? So the property and equipment is basically all the land improvements, the buildings, all the equipment, all of that. Now, certainly when we bought it, it cost well over $200 million, but then as you use an asset, you have to record a portion of that expense each year as you use the asset. So that's why we record it when we say it's net. There's the gross cost, but then we have to amortize a portion of it each year. So this is the net amount that's still left. Restricted assets. So these assets are restricted by some sort of external party, either by law or regulation or by some sort of contract or indenture. Most of these restricted assets are restricted by bond indentures. So when you do a particular bond borrowing and you happen to have a reserve that you're required to maintain, that reserve is restricted. It can only be spent in certain circumstances and on certain things by the contract that you indicated. The other thing is there are certain state laws, like when you put 10% down on your entrance fee, well, we do put that into an escrow, and it's restricted. We can't pull that out of the escrow until you basically move into the unit or accept the unit, okay? And then lastly, all the other assets combined add up to about $4.2 million. Some of it is receivables, like accounts receivable for monthly service fees. Some of it's for entrance fee receivables because we do have a deferred entrance fee program. Some of it's inventory, some of it's some prepaid expenses, and some other minor things that are in there. But you can clearly see from this slide, the biggest assets are going to be the property and equipment, the plant that we have here, and the unrestricted cash. On the other side of the balance sheet, so that was the assets, that was what Royal Oaks owns, okay? This is what Royal Oaks owes to other entities. So these are our liabilities. Certainly the bonds at $127 million. For those of you keeping score at home, I think last year that was about $144 million. So that's been paid down significantly. And I want to say it's even down a little bit further, down to about $122, $123 million. The reason for that is as people were moving into Inspirata Point, because that was our latest capital addition, our latest construction project, we used those entrance fees to pay down what's called the short-term portion of the debt. And then after that short-term portion is paid off, what we're left with is the long-term portion. Think of that like a mortgage. It's like outstanding for 30 years or 35 years. So in this particular instance, the short-term debt was paid off in April of 2025, so that was after fiscal year end. So that's why I said this has come down even more since 228. But we're going to be sitting at around 120-ish million, and then we're just going to be making regular principal payments like you would make regular mortgage payments. Deferred entrance fees. So most people, when they have those non-refundable contracts and you pay those entrance fees, that is something that we put on our balance sheet as a liability, not because it's owed back, but because we have to take, just like an asset, when we take that asset and we put it on our balance sheet and we allocate a portion of it each year when we use the asset, we have to do the same thing with these revenues. So the entrance fees, we take the entrance fee, we defer them on our balance sheet as a liability, and then we recognize a portion of that entrance fee each year. So for each and every one of you, yes, I keep track of your entrance fee and how much of your entrance fee I get to recognize each particular year that you're here. Okay? And there's a long, complex calculation about how do I arrive at that number for each resident, but trust me, we do keep track of that. The refund liability, so 15.5 million. So the refund liability will consist mostly of those refundable contracts. Some of you have 90% or 50% refundable contracts. So that amount that is refundable back to you or back to your estate when the contract is completed, then that is that particular liability. It's separate from the deferred entrance fees. If somebody is on a non-refundable contract and they move out a little bit early, that's rare, it does happen, then we do calculate if there is any refund owed, and if there is, we'll move it over to that refund liability. But that refund amount is definitely monies that are owed back by contract to residents and or residents' estates. Vendor and payroll accruals. So last year, I think up here we had construction payable of like 6 million, but all that construction projects are done. Inspirata Point is done, the dining remodels are done, so that construction liability's gone away. But we still do have normal accruals as far as accrual for payroll, payroll-related taxes, health insurance, all those types of benefits, pension accruals. When I say pension accruals, I mean they do their own, the employees handle their own retirement, but sometimes we help match it. So the other thing is just normal accounts payable, vendors, that we happen to owe invoices to. And then lastly, all the other liabilities that don't fit into either one of these buckets is about 4.6 million. Those can include a myriad of things: the matured portion of current debt, the interest payable at that particular time on the debt. It can also include application deposits and other things. We do have some community residents that put deposits down. So there's a myriad of other things that are included in there. But all told, those are basically a snapshot of the liabilities. So let's bring it all together. Our total assets at 228, so at February 28, 2025, $280 million in assets. Total liabilities, about $236 million in liabilities. And then for a nonprofit, your assets minus your liabilities will equal what's called your net assets, $44.5 million. That's your equity. For those of you that may have owned your own organization, this is what's probably called owner's equity, but with nonprofits, you don't have any owners per se. So it's called net assets. So the balance sheet is really good at telling you what the picture of that organization is on one particular day. And in this case, it was February 28th. But to see how did the organization change during the years, then we have to go to the other statement, which is called the statement of activities. And that's basically your P&L, okay? So we're going to start with our operating revenues for Royal Oaks, okay? You can clearly see at the top, 23 million of monthly service fees, followed by some healthcare service revenue. All told, we've got about 31 million. So the 23 million at the top, the monthly service fees at the top, that's monthly service fees for those residents that are in independent living. And then under health services, you also see another number for monthly service fees. And those are the monthly service fees for those residents that have permanently moved to a higher level of care, okay? So all told, between the two of them, we've got 23 million, almost another 4 million So just about 27 million out of that $31 million is monthly service fees from residents from various independent living, assisted living, and so on. We also do have what are called community residents. These are residents that are directly admitted into our higher levels of care without life care contracts. So we do have a little bit of capacity in our assisted living areas, and occasionally we get somebody that says, look, I don't have a life care contract, but I either am in need or I have a family member or a client that is in need of these services. And if we have the capacity to do so, we will go ahead and admit them into our higher level of care. But they, not having the life care benefit, they're going to have to pay that market rate. And that market rate can be, as high as $9,000 or more per month, compared to, say, something of your monthly service fees, which are $3,000, $4,000, and $5,000. So you really start to see the benefit of that life care contract. Meal per diems is in assistance. So your contract, your life care contract does have 1 meal per day, but as you go into higher levels of care, there are additional meals that are provided for you, and those additional meals do come with a particular charge associated with them. But you can see $684,000 compared to the tens of millions of dollars, so it's a small portion. Supplies and other items, $37,000, not really material. Other revenues, these are all kinds of other ancillary charges. If you happen to have, if you use our catering department and you pay for catering, goes in there. If you go over on your dining dollars, goes in there. If you do a refurbishing on your unit and there's a portion of it that you pay, goes in there. If you do a transfer and there's a transfer fee, goes in there. So you can kind of clearly see is any sort of ancillary charge that Royal Oaks may have that's not part of the monthly service fee and not part of the contract basically goes in there. So all told, this is about $31 million of various fees for residents across a 12-month period. So that's the money that's coming in. So we get the money that's coming in, but there's a cost associated with this, providing the services to the residents. So those are the operating expenses. And you can clearly see right at the top, salaries and wages of $17.5, almost $17.6 million. And that's just the salaries and wages, okay? The next line is actually employer taxes, health insurance benefits, retirement matching, dental benefits, other types of benefits that we offer to our employees are about $3.7 million. So out of the total $33.6 million, you're looking at almost what, $22 million? 2/3, over 60% of the costs associated with providing services to residents is people. It's the staff. And that makes sense because that is what we're in. We are in a people industry. We hire people to care for and take care of the residents and provide services to the residents. And that's not going to change anytime soon. I can't get a robot to cook you dinner. I can't get a robot to, if you need health services to help you get up. There's still going to be a lot of hands-on in relation, not that I'm looking for robots to do any of that. I'm just saying I know there's a lot of technology advancements, but if you really take a look around and what we do, it's people serving people. And I don't see that changing anytime in the future. So that's going to continue to be the vast majority of our expenses. After that, medical supplies and drugs, $65,000. I really only leave this up here because it is a small dollar amount, but for those of you that were with us in 2020 and 2021, during COVID, that number was $250,000 a year, if not more. Yeah, those medical supplies were very expensive. They certainly have come way back down, which is good for us. Professional and contracted services, $3.2 million. You're going to have all kinds of things in there. You're going to have insurance. You're going to have attorney's fees and legals fees and any other type of professional service that we outsource. Even another example would be like Mission Linen. They do a lot of our linens for us in the assisted living areas. And so all of that is in there as well. Professional and contracted property and equipment services. Let's go down one. Don't need to keep repeating myself. Property and equipment services, this is about $1.8 million. This is all the parts, maintenance, repairs to keep the facility and the equipment running. It does include, even if we have to hire that out, if we have to do some plumbing repairs or electrical repairs or HVAC repairs or parts, it's all getting recorded into there as well. Food, $2.8 million. So this food is the raw food that comes into our kitchens, okay? And that they basically use to prepare all the meals across the entire campus. $2.8 million. So, and I made a comment that I don't think it's the number one dollar amount, but it certainly is probably the number one volume of product, which is bacon, runs through there a lot. Okay. Utilities, $2.2 million in utilities. This is your typical utilities, your electric, your gas, your water, sewer. Again, if you happen to have last year's presentation handy or you looked at it before you came here, that number is quite a bit bigger. It was about 1.8 million last year. It's about 2.2 million this year. Certainly some of that is bringing some buildings online. I'm not going to argue that point, but more than half of that is actually made up of increases in fees, mostly APS, electric service fees. Everything else that doesn't quite fit into all those categories is $2 million. I mean, we've got all kinds of required education that we have to provide to our staff. We have various dues, fees, and licensure that we have to do, various supplies that we have to purchase to perform services. Even if we do have a little bit of travel, some of our staff do travel. I mean, granted, it's like each one of those is a very small amount, but it just adds up, over a 12-month period to about $2 million. So $33.6 million in operating expenses. So we've got about fees from residents of about $31 million, and we have operating expenses of about $33 million. So we've got a net operating margin to the negative about $2.2 million. Again, if you compare that to last year, that was up over $4 million. And I think from 2 years ago, that was up over $6 million. And the reason for that is it just has to do with when you build a new addition, we built 156 new homes, and as each of those homes come online, we have those startup expenses. In other words, we have to staff up first. We have to get the services online first, the electric, the insurance, all of that, the staff. And so what happens is you get the operating expenses ramp up first and fast, and then as people move in, the monthly service fees ramp up at a little bit of a slower rate. But you can see, especially if you look over the last 2 years, because that's when the Inspirata Point was coming online and people were moving in, you can clearly see that the operations are starting to get back to, they're still at a loss, but we've been able to make about a $2 million progress over each one of the years. And we're just about there now. I want to say at 228, our occupancy campus-wide was about 83%. We're actually up to about 85%. So as that keeps increasing, that bottom line, that net operating margin, that loss shrinks and shrinks and shrinks until it basically starts to get a little bit to the plus side. Yes, we are a nonprofit. We're not looking to make a big margin here, but we do want to get that to break even or a little bit on the positive side in case we have to weather any sort of economic storms. Okay? So, net operating margin, $2.2 million to the deficit. We do have interest on our long-term debt, which is about $5.8 million. So that's about $8 million. Now, this in and of itself is not unusual. A lot of the CCRC models, the entrance fee models, do rely on the turnover of entrance fees to help pay for the capital costs of debt and acquiring new buildings, okay? That is the financial model. Most of them will have a negative or a break-even NUM, maybe slightly above, and then basically they'll have their interest expense that'll help be covered by the turnover of independent living, okay? So we have 502 independent living homes on this campus. Right now, on average, anywhere from 35 to 40 of them every year will become available. And it's just people that move through the continuum of care, okay? People that need to move over to assisted living and whatnot, okay? And so when we're able to sell and get those people to move in and pay their entrance fees, they're coming, part of their entrance fee does help to offset that cash flow of the interest going out. and then part of it also is, goes into the operating reserve as well. So this is a normal financing model for an entrance fee life plan community. So bring that $8 million down. We do have other resources that can help cover that deficit too. Okay, so it's not just entrance fees. There are other things available. We do have our investment portfolio, and so we can use the returns on that portfolio to help pay for some of this. So we've got about $2 million in interest and dividends. We've got a $60 million portfolio, and we can see the investments and we can see the dividends and interest and get that relatively predictable between $1.8 and $2 million a year. Realized gains of $6.8 million. Now, granted, this was a bit of a banner year for those realized gains. I mean, normally we might have a couple million, maybe 3 million. So what a realized gain is when you have investments, if you buy an investment for, say, $100 and then you sell it for $120, that $20 is a realized gain. You get to capture that, okay? So you spent $100, but you get $120 back. So you have your cash of the original $100 and you have the $20 gain. An unrealized gain would be I purchased an investment for $100 and now today it's worth $120, but I'm still holding on to the investment, which means you have an unrealized gain. So it doesn't become realized until you actually sell it and liquidate it. Investment expenses, $265,000. So our portfolio is actively managed, so we do have to pay our investment manager. But for those of you that are maybe doing the calculation, if you look at because I think last year was a $64 million portfolio, this one's about $61 million portfolio. So but if you do the math, it's about 45 basis points, which is really good for investment management fees. I've seen some that are 75 or 100 basis points. So good, doing well there. We do have contributions here of $2.1 million. I know you may be asking yourself, well, isn't that what the foundation is for? And the short answer is yes, it is. That is the philanthropic arm of Royal Oaks. We have that separate foundation. However, both organizations are our 501c3, and this year we actually were bequested. We were the sole beneficiary of a couple of estates from residents. And they had it written in their particular documentation that was set up several years ago that specified People of Faith Incorporated, which is Royal Oaks. So in that particular instance, we weren't aware that we were named that beneficiary at the particular time. And so when it finally came in, I worked with the attorney. And so this does go to Royal Oaks. So we brought it into Royal Oaks because that's where it was indicated. If you are thinking about a legacy gift, first of all, thank you so much for your generosity in relation to that. If you are thinking about a legacy gift, whether that's part of your estate or maybe as a beneficiary to a particular life insurance or an account, I urge you to get with Chuck, and he has all the information you need so you can provide that to your financial planner or your attorney so all that documentation gets taken care of. We also did have a transfer in from the foundation of $922,000 to help us with the funding of some projects, some capital projects. The vast majority of that was the renovation of the common areas of the EPA building, the Elegante Point Apartments that Chuck had talked about earlier. And then we had a transfer to Cactus Sky of about $3 million. So Royal Oaks has done transfers in the past. It's ranged anywhere, when I say in the past, it's been like the past 5 years plus. And it's averaged anywhere from $500,000 to $1 million per year. This particular year, because of the $6.8 million in realized gain, which was a little bit like I said, it was very high. Normally it's maybe a couple million. The board decided to up the transfer to Cactus Sky. I don't see a repeat of that at all. I think that's going to come back down to the normal $500,000, $1 million. It depends, at the discretion of the board. And eventually, I do think that transfer gets phased out. I don't think it gets phased out in the next 12 months, maybe not the next 24 months, but maybe after that. In that particular instance, that is the transfer in and of itself is a normal thing, but the amount, that's not normally the amount. That's a little bit higher than normal. If you bear with me just one moment, we'll take questions at the end. So we'll convert all of that down to an operating margin of about $613,000 to the plus side. And then there are some other miscellaneous items. They're non-cash items, okay? We've got earned entrance fees. Remember I talked about we have that $84 million of unearned entrance fees, deferred interest fees sitting on the balance sheet, and we take a portion of that and recognize it each year. Well, last year we were able to recognize about $9.1 million of that. Unrealized gain of about $13,000, so not too much there. Depreciation, $11.8 million. That's on the property and equipment. So we construct or we buy the property and equipment, put that on our balance sheet, and recognize a portion of that expense each year. So running about $12 million of depreciation on that. Marketing for expansion, about $2.9 million. Certainly there are some actual cash outlays there as it relates to advertising and various promotions that we do. But for the most part, that $2.9 million will start to be coming down and down and down as people from Inspirata Point have moved in. So all told, net income and loss for Royal Oaks of about $4.9 million, almost $5 million for the year. So definitely some ups, definitely some downs. There's definitely some one-time things that probably normally don't really occur during an average year. All told, about $4.9 million. From an operating margin standpoint, it was about $600,000 to the positive, but then when you add in some of these, particularly that depreciation, it does pull it down a little bit into a net income loss. Okay. So as we have go through the financials, the other thing that to keep in mind is we do have the outstanding bonds and we have covenants related to that, which basically are various metrics imposed by the bondholders that basically say, hey, we just want to help us keep track of your financial activity as it relates to either our repayment of debt or some other industry standards so that we can just see how you're doing. Because remember, we're not there, those bondholders, they own bonds for a lot of different organizations. And so like for comparability, they like to boil it down to some metrics. So we have two financial covenants. One is 120 days cash on hand, and the other is 1.2 debt service coverage ratio. Days cash on hand is basically take your operating expenses for the year, divide it by 365, you get your average daily expense, and then take that number and divide it into your unrestricted cash and investments. They're basically saying, if you had no revenues at all, how long would you continue to operate approximately? And we have about 718 days on cash, so a little under 2 years. The other thing is on the debt service coverage, they're saying, look, we know that you pay regular principal and interest to us every year, and we want you to run a calculation in our financials just to make sure that when you get down to the end of it, you're able to pay us 1.2 times that. And when we run the calculation, it runs at about 2.4 for last year, so double what the requirement was. So from that particular standpoint, meeting the metrics there. So for this particular year, for 25-26, I think the metrics are going to stay relatively stable. It might be around a 2.0 coverage again in the debt service coverage, around there. I think the days cash on hand will probably be between 650 and 700. It always depends on where the market is going to with that. When we get into 26, 27, they might come down a little bit, and that's only because of certain exceptions that they're allowing. Remember I told you when you have a capital addition like Inspirata Point, you have various startup expenses and startup losses. So they do let you do a little bit of a carve out for some, not all of those carve out expenses. And then eventually, as it fills up, they want to phase those back in. So they usually say, hey, take your revenues and expenses from that capital addition, just back them out for just a second so I can see what this looks like on your base activity. And then after a certain amount of time has passed and you're stable, let's add those back in and then take a look at it again. Not an unreasonable approach. On the foundation side, so everything that we talked about up to this point was just been the financial activity for Royal Oaks. On the foundation side, we're going to touch on that a little bit. Again, very high level. So we'll start with their balance sheet, their statement of net assets. At the end of the year, they have the same fiscal year, so February 28, 2025, $31.5 million. Most of that is in their operating portfolio. They really don't have too many assets other than that, so the vast majority is in their investment portfolio. They do have some liabilities, about $3 million. Most of that are gift annuity contracts. So the foundation does offer gift annuity contracts whereby they will pay interest to the beneficiary of those contracts for the remainder of their life. And so there's a complex calculation that says take the net present value of those cash flows and book them as a liability. And then, of course, the difference between the two is going to be net assets, which is $28.4 million. And even in those net assets, they break them down just a little bit further because, as mentioned, when Chuck was doing his presentation, there are some that donate with donor restrictions, and so we do keep track of that as well. So at the end of the year, we had net assets of about $1.6 million that were restricted by donors, as far as these were donations that were received by the foundation that have not yet been spent on their restricted purpose, okay? Sometimes the foundation has to wait for that opportunity to present itself to spend it on that. But the other assets, $26.8 million, unrestricted net assets. So the vast majority in the foundation is for unrestricted, which means it can be used for any of the particular programs that the foundation has. Okay. As far as how did it change, what kind of activity did it have during the year? About $1.1 million of contribution revenue. That's up a little bit from last year. Last year, I think it was like $900,000. Net investment income of about $4.2 million, $4.3 million, and that does include everything. That's interest, dividends, realized gains, unrealized gains, plus, or in this case, minus any investment fees associated with those. We did have program services of about $2.7 million, and most of that you can see right here. We had various resident subsidies of about $500,000. We had the EAF of the Employee Appreciation Fund of $710,000. That includes both the donations that came in from the residents that went right back out to the employees, plus a portion of the taxes, so that the employees would get, the full amount. And then there was a transfer to Royal Oaks that was mentioned when we talked about Royal Oaks for about $922,000 to pay for various capital improvements. Certainly the largest of that being the remodel over at the Elegante Point Apartments. All right, switching topics. So we talked about all the financial results of what happened last year, and now we're going to switch it. I've been presenting this slide for the last few years of just inflationary update. It used to be a hot topic. It's not as much, but it's still very relevant. So you can clearly see the big spike and then it's come down. So this, and you can go look this up. I just pulled this is off the United States Bureau of Labor Statistics, 12-month percentage change consumer price index, select categories, non-seasonally adjusted. And so this is generally the rate for the most part that you kind of hear in the news a lot. And so it's not quite at 2%. The Fed keeps targeting 2%. But if you see in this graph here, it's tiny. This line is 0, this line is 5, and you can clearly see if we go all the way down to the end, this line is not quite in between. It's trying to get there, but it's hovering at around 2.5 or so, okay? So they haven't quite gotten to that 2 yet, but we've gotten past that big spike. And so when I drilled down and I looked at some of the numbers that are behind here, I pulled up some of the information, which is what the current CPI is as of July 25, because August wasn't available yet, 2.7%. So that was the year-over-year inflationary rate through July 25. Average over the last 20 years has been 2.58. Okay? Notice neither one of these numbers are what the Fed says their goal is. So at some point, I presume they're still working towards it. There are smarter men and women with me that are supposedly working on this, and they haven't quite gotten it yet. That big spike that we saw in the graph, okay? I did take a look at that. From May 2021 through March of 2023, so right here, this big spike right here. So from May of 21 think it was May or March. Yep, from May of 21 through March of 23, over a year, inflation was never less than 5%. Got as high as 8 something, was never less than 5. That's a long time to be at that high of an inflation. So then I said, well, what happens after March 23? Let me take a look at that. So after March 23, from then until July of 2025, so another 2+ years, it's at 3.14%. So it came down, but you can clearly see it's coming down very gradually. Now, this is not equal across the board, okay? Remember when I talked about medical supplies, it was 250,000, it's back down to 65. So obviously, it's actually had a little bit of deflation there, okay? Some industries are only moving maybe about 1%. Okay, but it's not hitting every industry or every area of the country equally. These are just averages, so make sure you take them as such. And I invite you, if you're interested in this, they've got a ton of data on that website if you would like to go look at it. So let's look at it a little bit more of a macro level as to what's expected to hit Royal Oaks, okay? So utilities from our fiscal year 23-24 to 24-25, they went up about 19%. I project they may actually go up another 15% from the current year to next year. And the reason I say that, it says 15%, is APS released a notice that they put into the Corporation Commission like a 15.9% increase. And this was just like a week or so ago. Now, we'll see where the Corporation Commission eventually lands, but you can see where the starting point is. They want a 15.9% base rate increase is what they're looking for, okay? So there is a distinct possibility it could be double digits. Maybe it's not as high as 15%, but it could be double digits. Property and liability insurance, it is up 36% from 23-24 to 24-25. Now, in this particular case, we planned on that. We were adding new buildings. We had more square footage. We planned on that, okay? Certainly, the insurance cost was a little bit higher than we expected. We didn't expect 36%, but we knew it was going to be like somewhere in the 30%, right? So in that particular instance, it was a little bit of a sticker shock, but we had anticipated quite a bit of that. Now, we are currently out to bid for our property and liability insurance. The market looks like it might be a 5 to 10% increase. I won't see any of the bids. They're still out there. I'll probably start seeing the bids come back at the end of this month, beginning of next month, for our property and liability insurance. So we'll see where that lands. I do expect an increase. Certainly, I think it's going to be a minimal 5%. I don't think it'll be as high as 10, but that's kind of like where they've been kind of, when they've been talking to our broker, these are kind of the signs that we're getting. Employee health insurance increased about 18% from 24-25 to 25-26, which is the current year that we're in. I will tell you, I've been reviewing our health insurance claims. So these are claims for the employees that are on the health insurance plan. They are running a little bit higher than normal. They're running at about 115 to 120% above where we, in other words, they're running about 15 or 20% higher than where we anticipated. However, the vast majority of that was in the first couple months of the benefit year. And I only have like 5-6 months of data. And the last few months, the claims have been much less than what was anticipated, so that number is starting to come down. We won't go out to bid for that until later in the year, and I'll have a few more months of data for that. So I don't know exactly where that one's going to land. If claims keep trending as they have been, I'm not expecting a double-digit increase, but it could be. There's certainly probably will be a little bit of an increase because we've had increases in claims. Okay. Wages and salaries. Again, this goes back to the U.S. Bureau, Department of Labor. Across the nation, this is through June 2025 because the July wasn't out yet when we looked at just wages, employee wages and salary average growth, about 3.5%. That's down last year, I want to say, from about 4 or 4.1. When we delve a little bit more deeper, because they do break this down by like industry segments, I took a look at what's going on in leisure and hospitality. So leisure and hospitality really competes for a lot of our cooks, servers, EVS. We are a tourism state, and there's a lot of resorts here. So we do have to compete for that particular labor pool. And that's running at about 2.9% on wage growth. And this is just wage growth, by the way, not total compensation. But wage growth is about 2.9%. Healthcare and social assistance, about 4.5%, which the leisure and hospitality is down from the prior year. It was up over 3% last year, so it's down. But the health and social assistance at 4.5% is still the same as it was last year, okay? And I will tell you, the health care industry is a very people-oriented industry, okay? Not to say that leisure and hospitality isn't, but there's certain things that you can do with leisure and hospitality that healthcare doesn't lend itself to do. As I said, you're still going to need skilled doctors and nurses to perform medical procedures or to take care of patients and things of that nature. Okay. I'm going to add this. It's a little bit of a regulatory environment. Over the last couple of sessions, the Arizona legislature has been a little bit more active in the senior living space as far as wanting to put some new regulations in place, some of which are very costly. Now, they didn't certainly get all of them passed, but there's one in particular that did pass that does have a little bit of an impact. But I wanted to share this with you just so you can kind of see what's going on. So there was some additional memory care training for staff that is being required. And when I say staff, I mean darn near all staff. So it's not just limited to caregivers. They have this requirement for everybody that happens to walk through the building. So that includes EVS, that includes administration, that includes facilities. Anybody that could potentially walk through that building and have an encounter with a resident in memory care, they must undergo this training. And when we really add this up, for us, it has about an impact of about $75,000. Now, you saw our expenses, $33 million, $75,000 isn't that great of an impact. We can absorb that, I get it. But the thing of it is they've had other proposals that didn't quite get through, okay, that could have had a much bigger impact. Now, at being a 501c3, we can't go down there and lobby. We are a part of a state organization called Arizona Leading Age, and they can go down there and lobby on our behalf. But what I'm doing is I'm really just trying to keep an eye out for all these regulations that might be coming down. Here's another one. The Department of Health Services, we just renewed our license with the Department of Health Services, and it was running about $14,000 or $15,000. But next year, they've already indicated they're going to increase their fees by up to as much as 40%. Again, on $15,000, you're only looking at, another $6,000 or $7,000. We can absorb that. But this is why we want to stay active with Arizona Leading Age as far as keeping an eye on the Arizona legislature, because this could be death by 1,000 cuts really quickly if they input a lot of regulatory on here. And I'm not saying some of the discussions they're having down at the legislature are not warranted, but the thing about it is we have to look at, what is the cost and what is the value of that regulation to the residents that it's supposed to be impacting. Now, I don't really have it here, but one of the things that I've been thinking about doing, and I did ask the first group here, is maybe having a separate presentation sometime in the spring when the legislature is in session, so that I can at least bring you, hey, this is what's going on down at the legislature that may impact senior living. Now, as a 501c3, I'm just going to be plain Jane and just give you the information as I know it. I might just say, these are the bills that are being circulated. This is the potential impact that we think it might have. And for us, we have to go through our organization, Arizona Leading Age, in order to lobby or meet with legislators to kind of talk to them about, can this bill be changed? Are you sure you need this? Can we, for lack of a better word, kill this bill? We have to do that through Arizona Leading Age. We don't do it. That organization does it. However, if I give you this information, you may do with it what you will, because each and every one of you is still an independent registered voter, I suspect. So, but like I said, all I'm going to do is give you the information, and if you're okay with that. And so just a brief survey, show of hands, who would like information like that, just to see what's going on at the legislature that might have an impact? So quite a few of you. It's about the same number of hands in the first group too. So this is probably something that I'll bring to you in the spring sometime, just to say this is what's going on down there. Just so you at least have the information and you're armed with information, you can do whatever you would like with it, okay? All right, good feedback, I really appreciate that. Okay. So lastly, I don't really have a slide on occupancy, but I did touch on it a little bit. As I said, at 228-25, we were at about 83% campus-wide. We're at about 85, a little over 85% right now. As far as Inspirata Point, we're sitting at about 138, 139 occupied homes over there, and there's still another 4 or 5 that haven't quite moved in yet. So we've got, we're down to like the last 10 to 12 homes over there as far as being available. So that's actually doing really well. At the traditional Royal Oaks, 3-story building, almost pretty much all the garden homes are either full or there's some sort of contract on it. And inside the apartment building, we're also sitting a little over 85%. So the goal that we're trying to reach by the end of the fiscal year is around 87, 88%. It's a hard goal, I know it is, but I've got a very superb and capable marketing team. And I also have very friendly residents. You guys have actually been doing a fantastic job, all of you here, because the number one thing that really helps Royal Oaks is the residents that are here. When you invite your friends to say, come and see Royal Oaks, come have dinner, when you talk about all the activities at Royal Oaks, when you go out to the community, to your church or another event and talk about Royal Oaks and say it's a great place to live, those really are some of the best advertising that we could ever get, and I am appreciative of it, and I'm thanking you so much for doing that. Lastly, I'll open it up to questions. So we rambled on for about an hour and 5 minutes. So first of all, thank you for your patience. I got your question over here. I know I saw your hand up earlier. Let's get you a microphone real quick, if we could, to this gentleman right here in the checkered shirt. Yes, thank you.
A couple of slides ago, you had a 2-something transfer to a copper something.
Yep.
We back here don't know what copper something is.
Okay, fair enough.
Cactus Sky.
Cactus Sky, right. Okay, totally get it. And sometimes that's my fault. I always forget. We've got new residents or prospective residents. So what it is, Cactus Sky Holdings is a separate organization. It's an LLC, okay? But Royal Oaks is the sole owner of that organization. So Royal Oaks, several years ago, formed that LLC and began transferring cash to that LLC in order for that LLC to look for opportunities to purchase land and other opportunities. So some of you will notice that, some of you may remember, we actually were able to buy a couple parcels in the back. I say in the back, it's actually over there. A couple parcels. We bought we call it the Bob Brown property. It was the Service Experts. It's about 1 acre. And then there was the Daily News Sun lot, which is about 2.7. The reason that we did that is basically because with Royal Oaks, they have outstanding bonds. And with those bonds, there's a deed of trust, which basically says all of the property of Royal Oaks and the operations are security on that debt. So if Royal Oaks goes out and tries to do any sort of acquisition, whether that's land or anything else, when Royal Oaks buys that, it immediately becomes part of the deed of trust and is now security on the bonds. So what a lot of CCRC nonprofits do is they'll form a separate organization that's kind of like this little development fund outside of what's called the obligated group. Okay, so you take some of the cash, you transfer it outside of Royal Oaks, granted, on paper, and so now it's outside of the obligated group. The obligated group being defined as this is who's responsible to pay the debt. Once that cash is outside the obligated group, now when that purchases land, that doesn't automatically get attached to the deed of trust. So now you've given yourself flexibility of if we purchase the land, when do we have to bring it into operation, and what do we want to do with that particular piece of land and things of that nature. And so, because if that land ever became part of the deed of trust and then all of a sudden Royal Oaks decided, we don't want that anymore and we have to dispose of it, well, now it's part of the deed of trust, so we have to separate it, and it becomes a lot more difficult to do that. And so that's why you usually do those transactions outside of the obligated group first, and then make the decision, a very calculated decision, to bring that into the obligated group at a later date. So that's what Cactus Sky is basically utilized for. Now, Cactus Sky eventually will be transferred over to Aventure, which is the parent organization. But that's basically what it's there for. That's what it's there for. So good question, and I apologize. I didn't realize not everybody may have had that history. All right, anybody else? Okay, one here and then there. Okay, so 1, 2, 3. Okay.
Carter, you showed on one of your slides the debt service coverage ratio.
Yes.
And I noticed, looking up some data, that about, I think it was a year or so ago, maybe September, the bond rating agency dropped Royal Oak's bond rating as a result, it looked like, of that ratio as well as the occupancy rate. I'm just wondering, is that something that's going to get revised, or is that something that's going to have an impact on Royal Oaks overall as a result of those numbers?
So the question is with the debt service coverage and other metrics such as occupancy, over the last 2 years has been maybe an impact on the rating, that the credit rating that Fitch does. So when we originally did the project for Inspirada Point, Fitch rated that as a triple B minus, and they since have downgraded that to a double B plus, which is one downgrade, okay? And then last year, they just affirmed that double B plus, I think. They didn't do anything with it. So basically, at this particular point, the change in that Fitch rating, whether it goes down or up, has no impact on Royal Oaks unless Royal Oaks goes out and tries to do an additional borrowing. But even then, that's one factor of many because you could make the argument, well, if you're higher rated, you get a lower interest rate, and if you're lower rated, you get a higher interest rate. And the short answer is, yes, that is true. But sometimes timing is everything too. Interest rates 5 years ago are not interest rates where they were today. So in that particular instance, people say, is there an impact? It's not like we have any sort of triggering mechanism in any of our debt documents that says, if you go to a certain rating, your interest rate triggers up or anything of that nature. So in that particular instance, it's for us, we basically use that Fitch rating as a particular guide to say, okay, if for whatever reason we ever wanted to go out, this is the credit rating we'd have, and this is the interest rates usually within that credit rating. We use that as kind of like a guide as to like where do we think our cost of capital would be.
Just to follow on to that.
Yes.
When you look at the comparatives from other CCRCs in the greater Phoenix area,
Yes.
It showed some comparisons, and Royal Oaks was compared not as favorably with the exception of the cash available. Do you ever look at those things and worry about the consideration about how others are?
Well, we do, and it all depends on who are you looking at and when are you looking at them? I'll give you an example. If you compared us to Sun Health, well, Sun Health is a larger multi-site organization. Their rating is higher, and they're certainly even more mature than we are as far as a business. So I think on that one, yeah, we're probably going to be compared a little bit smaller or not as advantageous. Then you can compare us to Friendship Village of Tempe. Friendship Village of Tempe, they're actually not rated at all as far as like a Fitch rating or anything of that nature. And that's because they're actually going through a lot of repositioning on their campus, and they're actually about to enter into phase 3. If you looked at their financials, if you looked at their financial activity, they're probably relatively comparable. They're doing a little bit better on their operating margin. They've been able to leverage skilled nursing that we don't have. When we had skilled nursing, we were not making any margin. It was actually contributing a deficit, which is why we moved away from it. They've actually been successful on the other end as to basically help. And so when you make skilled nursing become a plus instead of a negative, that will help your operations. But you're right, from a cash standpoint, we're stronger than that. If you compared us to Beatitudes, we're stronger on every metric. We're stronger on operations. We're stronger on our occupancy. We're stronger on our cash. So when I do compare us to other nonprofits, I do have to look at the situation that they're in. So Sun Health, they're in a good position. They're very mature. When I look at Friendship Village, they're kind of doing some repositioning and expansion. So that's actually a relatively decent comparison. They are a little bit bigger than us, and they've been able to leverage their skilled nursing more successfully, which is why they still do it, and they basically double down on it, which is great for them. When I compare us to Beatitudes, Beatitudes has had some struggles with some cash and some occupancy, so they're in a little bit of a rebuilding mode. So I keep that in mind. So I do look around, but I also have to look at the context of what each one is going through, so I can try to compare apples to apples as best I can. So over here and then there. So right here.
Yes, thank you.
Yep.
There were two items on the expenses that I was interested in a little explanation. You had $2.8 million expense, food expense.
Yes, food.
And then you had professional and contracted services at 3.2.
Yeah.
I thought we contracted out the food to the Morrison Company. So could you explain the difference between
Right.
those two line items?
Sure. So the question is you have food expense of 2.8 million and professional services of around 3 million, I think it was.
3.2.
3.2 million. And we do use Morrison as an outside service. And that is true. So what that food is just the raw food. It is the chicken, the fish, the vegetables. It's the raw food that comes in. It's the commodities. Okay, so there's no services in that 2.8 million. So whether we were using Morrison or not, we would be spending that amount on raw food or more without the Morrison contract. The Morrison contract fees are sitting up in professional services, okay? So in that particular instance, one is just the raw food commodity, because even though we utilize Morrison and we use their purchasing network, in other words, they do the buying for us, but we still have to pay for that food. So that's just a pass through. So they have their management contract, their management fee contract and all of that. But they also say, we also had these food purchases. And when they say we had these food purchases, they send us all the invoices. We have access to all of that. So it's not like they're doing a markup on that. They're just charging us the service. But the raw food is the raw food. That would be the same number even if we weren't using Morrison.
And a follow-up question to that then.
Yes.
With the formation of Eventor,
Yes.
Life Care Resources can be, I mean, they're available already. Are there not Life Care Resources companies or organizations
Oh, yes.
that we can become part of?
Yes.
And get immediate results instead of having to wait to formulate, a network
Right.
of mergers.
Right. And so the question is with the formation of a venture to grow as a senior living organization that kind of handles multiple sites, there are already multiple site companies out there that exist. Some examples that you may have heard of are Axe and Human Good and the Covenant Network or LifeSpace or something of that nature. Yes, there are organizations out there that we could have become a part of, but basically when you do that, you're going to give up that Royal Oaks identity with it, and you're going to give up that particular culture. So that was a discussion at the board level to say, is that the direction that we want to go, or do we want to kind of start from our own organization? And even we didn't have to always look at the big ones. Those are just the big ones I named. There are smaller ones out there. Maybe there are only 2 or 3 communities. And the consensus on the board was we would rather do it organically than join one of those organizations. And so each year, a venture is going to have to take a look at that as to is this something we want to still continue to do? Or do we look at, another venture with another organization? So even though you make that decision one time, you still reevaluate it every couple of years. But at that particular time, the consensus was, no, we would rather do it organically. And again, they didn't make that decision in a vacuum. They looked at other organizations that had done the same thing as far as starting, that parent organization organically, and to use those as examples in data studies.
Yeah, I did notice that there was a proposed merger between the Life Care Services organization out of Des Moines, Iowa, and they're going to merge with the V organization with about 10 different locations across the United States. That was interesting in as much as that the V is a very reputable, high price type.
Yeah, the V is, but at the same time, V is for profit. They're not non-profit.
But by the same token, LCS is a formation of companies of nonprofit and profit.
Right. So when they do this merger, they'd have to figure out how that's going to work.
Right.
I agree with you. Absolutely.
Yeah, apparently they have nonprofits integrated.
Yeah. There's some organizations that do have both. Exactly. But the trend that you're noticing, I don't disagree with it. You have right now you have large merging with large. That's pretty typical what I see. When I see a large one that's kind of incorporating a smaller group with it, that group is usually a little bit struggling. So when I see like a small single site or two site join a larger one, typically it's usually because that small single site or that smaller one is struggling. But when I see the two coming together, it's usually just two equals coming together or near equals.
Thank you.
Definitely the trends. And then Dirk over here, he had a question, and then way in the back. Okay, in the back, and then you, sir. So, and I forgot you. Okay.
My question is, how does Accenture and the thing we hear about in Louisiana, how does that impact overall what we're doing? Is it a positive thing, a negative thing, and is there a money problem or thing?
Oh, yeah. So as far as, Adventure had that affiliation acquisition of the Glen over in Louisiana. Is it having any sort of impact on Royal Oaks? It doesn't have any impact on Royal Oaks as far as like it's not increasing the fees or taking services away or anything like that. Now, I'm not going to say it doesn't have an impact on my time. It certainly does. But that's a time management thing for me. So I would say, if you ask, like, how is it going? Basically, we're about 4 months in, and the first 2-3 months we went over there, did an evaluation of things that need to be corrected. Are they hurting for money? No. Did they need a little injection? Sure, they needed a little bit of an injection. But the reality is they just need help doing a little bit of a turnaround. And so we went over there. When I say we, it was myself, Gretchen, and Dina. And we've evaluated some of the operational things that they're doing and or that they're not doing. And we've come up with basically a plan that we shared with their CEO to say, this is where we think you need to be in 6 months. This is where we... Is it here? Is it back? Oh, there we go. This is where you need to be in 6 months, 8 months, 12 months. And at this particular point, it's about executing that particular plan, which they are in the beginning process of doing that. So it's basically the same thing that you would probably see in another organization that you might affiliate or acquire, which is, we need to find some operational savings, and at the same time, we need to pick up their occupancy. In their particular case, they do have skilled nursing. They need a little bit of an occupancy boost there, which they've actually started to see. They've gone from about 90 beds on average to about 100, which is really good. And then they also have an assisted living building, which is needing a little bit of occupancy, which they've been able to improve a little bit so far. So far, it's trending in the right direction. But again, we're early in, and it's like, yeah, these are positive trends, but we've got to sustain that. So sustain the trends, I mean. So, all right. So one in the back, then here, and then John.
Can I ask one other? Since I have the mic, what near-term or long-term projects are you planning to see that is coming from the board to impact us here at Royal Oaks?
Okay, so what are some long-term projects that coming from the board that would impact Royal Oaks? We just recently had a master planning meeting just for Royal Oaks. Had nothing to do with the Glen, had nothing to do with the Venture. It was just Royal Oaks. And we wanted to see like, what's the next step for Royal Oaks? And we have a strategic vision, and we have a strategy meeting. We're actually going to meet not next week, but the week after to see how can we execute that. And once we have some of that data, we'll probably start releasing some of that, maybe in a presentation to the residents. But in that particular case, we want to take a look at the master plan is taking a look at the physical footprint of the campus and where is that next improvement. And we have to take a look as to what are things that we want to add to the particular campus because the residents have been asking for it, and what are things that are maybe a little bit obsolete that we need to either shift or move to a different part of the campus. So I wish I had something more concrete, but that's still such in the conceptual phase. I don't want to sit here and say, we're doing all these 20 things, but we only get to like 3 or 4 of them because, money is money, right? So, and time is time. And if the other thing is we also have to factor in how much disruption, if we do another something on the campus, how much disruption is that going to cause to the residents? So we're very strategic about what do we do? How do we finance it? What's the disruption? Those type of things. But yeah, we've already had one master plan update on that, and now we're looking into doing an overall strategy of how we can start moving forward on that master plan to get a concept so that we can start maybe releasing some information to the residents. But it'll still be some time before I can release that. But in that particular instance, the board and senior management is already working on that.
Okay, this is just one question about the care center. Excuse my voice. Could you tell me what they're planning to do at the back end? Those rooms are all closed.
Yep.
It generated a lot of income for us. Have they got plans for that? Or could you just fill us in? Because a lot of us old timers have been wondering about that.
Yeah, the question had to do with the care center and what we're going to do with the back end of that. So with some changes in some state regulations, we did have to move all of those that needed directed care for memory care. We were required to move them over into the Friendship House. And so when we did that, the census on the care center became relatively, it went down from a census of like 42 down to a census of like 22 because we moved all of those people over to the Friendship House due to the change in regulation associated with that. Now, the reason that we closed down those particular wings is basically to try to minimize the operating expense associated with them. So right now we've got about 20 to 22 residents in the care center. And I think from a long-term perspective, I think what we're going to look at, and this is a conversation that has come up in master planning, but we haven't made a decision on how to do this, is we're asking, is there a way we can service these 20 to 22 residents over on the east side of campus where all the other services are? There's the assisted living apartments, there's the memory care, there's the Vita Center, there's all these services over there. And if we're able to basically reasonably accommodate them and service them over on that side of campus, then that might be better and overall be an operational savings if we were able to achieve that. Because I understand there is revenue generated from the care center, but it's also a skill. It was built as a skilled nursing model, and we're not running skilled nursing out of there. I mean, obviously, we're doing what we can with the footprint that we have, and so it lends itself to some inefficiencies related to trying to deliver assisted living services over there. And so we're trying to say maybe there's a way we can do that better. In other words, give them the same service or better on the east side of campus, and we're trying to figure out how to do that. Good question. And then you, sir, in the hat. So right here, do you have a microphone for this gentleman right here? In the hat right here? Perfect, thank you. And then we'll go to John in the back.
On your resident monthly service fees,
Yes.
I've heard that some residents do not have to pay increases. Now, I've never heard that before, so I need an explanation on that.
Right. So the question was, on the monthly service fee, are there some residents that don't pay increases? And the answer is no. There isn't always an increase that's passed on to every particular, that's passed on to every resident. Now, I will tell you that the foundation does have various subsidy programs. So we have residents that are on just individual subsidies that happen to run out of money. We have some that are on a 3%, flat 3% program. We have some that get a longevity program. So there's various foundation programs that help offset the cost of some of those increases, but there's nobody that gets that gets zero. No.
Okay, thank you.
You're welcome. John, there you are.
Yeah, on the air conditioning at IP, I think we're out of pocket up front, but we have claims. Is there a contingency fund or a reserve or?
Oh, yes.
You know,
so,
what?
Right. So for the HVAC improvements, the HVAC fixes, the air conditioning fixes that we made to the Inspirata Point Culinary Building, the dining venues, if you will. Basically, we funded that, and we funded that out of our operating reserves, the unrestricted $61 million that you saw. And so now we're still waiting on final sign-offs for that. I mean, we're back in it. The county signed off on it, still waiting for the architect to sign off and the final billing and all that. And then basically we're going to put our documents together and we're going to go back to the parties and say, okay, we got the HVAC where we wanted it to be, but this is what we had to do to get there. And we needed to have a conversation about how you're going to take care of some of this cost. So with each of the parties, though, we are under contract and we have to go through their dispute resolution phase, which you're probably more than aware of. Now, in the beginning, we didn't want to get the lawyers too much involved because we didn't want them to stop work. But once we've got the documentation and we present it to them and we say, hey, we want to enter into this good faith negotiation like the contracts indicated, at that point, everything's done. I can bring the attorneys in and just, if necessary, before we have to move to any other dispute resolution in accordance with the contract. But the contract first says that the managements will come together and try to resolve this thing, yada, 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 the typical language that you're normally used to seeing. But that's where we are. But as far as where did the funding come from, the funding came from the operating reserve, the unrestricted. As far as how much of that we're going to get back, don't know. I haven't started talking to them. I'd love to get all of it back. But you and I both know they're going to be like, well, if this, then that, if this, then that, and we're going to go back and forth for a little bit.
Right. So how much are we out of pocket? Or
so for just the HVAC additions that we made over there was just under $1 million. I think the total contract was $1 million, but there were a couple of things that we wanted to do while they were opening up the hood, while they were opening up the roof. So those things were like, okay, that's on us because we just want to make those modifications. The vast majority of it was, close to $1 million.
Is there anything remaining in like the contingency fund and the bond fund?
The bond funds are all closed out? No. So.
On a totally different thing, do we require employees to participate in health insurance?
The question is, do we require employees to participate in health insurance? And the answer is no. We offer it to them, but some people just have health insurance through another opportunity. They might have a spouse that works and they'd rather be on their insurance. So we offer it to them, but they're not required to be on it. No. There's nothing that says I can require health insurance. So yes.
Yes. I've had, since I've lived here for close to a year, I've always had a lot of problems with Dish. Is there
Dish.
a Dish, the TV system?
Yep.
And so I was just wondering what you can do about maybe getting another
Another provider?
taking care of it. Another provider.
So the question is we've definitely had problems with Dish, which has now been taken over by Marrow, I believe. I think the name of the company is. Is there any talk about replacing Dish? And the answer is not at the moment, because the only other viable alternative, first of all, DirecTV won't come back. They don't want to do these properties anymore. So DirecTV is not viable. Dish is pretty much gone. So the only one that's left is like Cox Cable. Now, Cox Communications, they actually do some other senior living communities, and I've gone out and I've seen them. But I'm going to tell you, their quote came back at double what Dish and DirecTV wanted when they were doing it. And so at some point, if we get to the point where we have to replace that particular system, it'll be a hefty cost. And when I say double, it's like the per year service. Yeah, they were charging a lot more.
Well, I used to have cops and they did charge more,
Yeah.
so
Yeah.
I can tell you're right.
Yeah, Cox Communication. The last time we went out to bid, we did have DirecTV, Dish, and Cox bid on it. DirecTV and Dish were pretty competitive, though Dish doesn't want to do it anymore. They would have probably, I don't know if they would have canceled the contract, but they don't bid on senior living really anymore. So really, Cox came in at the time, it was twice, if not a little bit more than twice the others. They were very expensive. So, all right, thank you so much. I've kept you so long. It's like almost, 3:30 here? I appreciate it. If you have any other questions, definitely let me know. If you would like a handout of the slides, we do have paper handouts available in the back, or you can stop by the front desk. Thank you.